Storage unit investing. Small business, big cash flow. Most people think you need $50,000 to start a real business that actually makes money. They're wrong. I just found out a guy in Phoenix is making $8,000 a month from 5 storage units. 5. That's not a side hustle. That's a second income stream most people don't even know exists. And here's what blows my mind. This is more reliable than stock market returns, more predictable than crypto, and it requires way less time than flipping houses. By the end of this video, you're going to understand exactly how storage unit investing works, what your real numbers look like, and whether this is actually the move for you. Let's go. Part 1. How storage units actually make money. Storage unit investing is simple. You buy or lease units. People pay you monthly rent to store their stuff. You keep the difference between what they pay and what you spend. That's it. But here's what makes it different from being a landlord. When you rent an apartment, you deal with evictions. You deal with tenant damage. You deal with lease breaks. With storage units, people rent month to month. If they don't pay, you auction their stuff and recover your money. No lawyers. No court dates. The national average rent for a climate-controlled unit is $95 per month. Non-climate controlled is around $60. A single unit generating $95 monthly sounds small until you realize your only costs are the facility lease, basic maintenance, insurance, and marketing. Let's do real math. That Phoenix guy with 5 units? He's probably running units at $80 to $100 each monthly. That's $400 to $500 gross revenue. His facility costs maybe $250. His insurance is $50. His marketing, mostly word of mouth and a simple website, costs him nothing. That leaves him $100 to $200 profit per unit. Times 5 units. That's $500 to $1,000 monthly profit. He's making $12,000 a year from 5 units with almost no active management. But it scales. Part 2. The real numbers and your options. There are 3 ways to do this, and your capital determines which path makes sense. Option 1. The joint venture play. You have no money. Someone else owns a storage facility and has empty units. You approach them and say, "Let me fill your units. I'll market them, rent them, and we split the profit 50-50. They make money on units that were sitting empty. You make money without capital. This is how people start with literally $0. Your only investment is time. You create a simple website. You run some Facebook ads. You fill units. You get paid. The downside? You're splitting profits, but you're also splitting risk. The facility owner already owns the building. Option 2. The lease and operate model. You have $5,000 to $15,000. You lease an existing facility or a section of one from an owner who's not actively marketing it. Let's say you negotiate a lease. You get 10 units for $2,000 monthly. That's $200 per unit. You market those units aggressively. You get them to $85 per unit occupancy rate. That's $850 monthly gross revenue. Minus your $2,000 lease. You're negative. But wait, you add more units. You lease 20 units for $4,000. 20 units at $85 monthly is $1,700 gross. Minus $4,000 lease cost, you're still negative. Here's the catch though. You get to 85% occupancy across 20 units. That's 17 units rented. That's $1,445 monthly. That doesn't cover your lease yet. This is why option 2 is tougher. You need volume. You need consistency. You need marketing skill. Option 3. Buy and hold. You have $30,000 to $50,000. You buy a small climate-controlled facility outright or with a loan. With $50,000 down, you're financing maybe $120,000 total on a $200,000 Facility. 20 units at $95 monthly gross is $1,900 monthly. Your mortgage, insurance, and utilities are probably $1,200. Your profit is $700 monthly. That's $8,400 annually from a facility you own. But you're building equity. Your property appreciates. Your mortgage shrinks. By year 5, when that property is worth $240,000, you sell it and make profit on the business and the asset. Part 3. The real talk. Storage units aren't passive income. They require marketing. They require customer service. They require maintenance. But compared to a rental property, the time investment is maybe 5 hours monthly. The barrier to entry is low compared to commercial real estate. Your break-even point is fast if you execute right. Most storage operators see positive cash flow within 6 months. The risk? Market saturation. Some areas have too many facilities. Your location matters. Research matters. But unlike stock market volatility, this is local. You control the outcome. This isn't a get-rich scheme. It's a smart, boring cash flow business that actually works. Call to action. If this resonates with you, you need to do 3 things right now. 1. Research your local market. Google self-storage facilities near me. Count them. Call 5 owners. Ask their occupancy rates. You'll learn everything. 2. Subscribe to this channel. We're dropping a complete guide on finding facilities for lease next week. 3. Drop a comment. Tell me, are you more interested in option 1, 2, or 3? I read every comment and I'm building our next video around what you actually want to know. This could be your second income stream. Let's make it happen. Subscribe. Let's go.